Bitcoin just crashed 32% from its October 13th peak, dropping to $85,000. But according to analysis published by JPMorgan this morning, this isn't a normal market correction. This is forced institutional liquidation. October 10, 2025. The moment US markets opened, Bitcoin selling began in an unusual pattern, not normal retail panic, not driven by negative news. This was systematic, methodical, institutional selling. According to on-chain data from Glassnode, over $20 billion in leveraged positions were liquidated in less than 24 hours. The selling occurred at precisely 9:30 a.m. New York time, every single day. Same pattern, same timing, same execution methodology. This isn't individual traders panicking. This is a large institutional seller, likely a hedge fund or market maker, being forced to unwind positions. Not because they think Bitcoin is worthless, but because they're required to liquidate. They're forced sellers, not willing sellers. Over the next 15 minutes, I'll reveal the hidden liquidity crisis driving this crash, show you the 3 on-chain indicators that predicted this exact move, explain why Bitcoin's fundamentals are actually strengthening during this decline, walk you through the Federal Reserve's role in draining market liquidity, and analyze whether this represents a generational buying opportunity or the start of a deeper bear market. Stay with me, because what you're about to learn will completely change how you view this crash. Bitcoin is currently trading at $85,000 at the time of this recording, down approximately 32% from its all-time high on October 13th. This is a significant drop, but here's what makes it different. This is the third correction of this magnitude in the current cycle alone, and we've seen dozens of similar drawdowns in previous cycles. But the feeling this time is different. The market isn't just fearful, it's experiencing something deeper. A sense that something bigger than a simple price correction is happening, and the data confirms this isn't just emotional perception. Something structural broke in the market. Let me share something Warren Buffett always says, and this principle is critical right now. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This wisdom needs to be carved into your investment psychology. Because right now, everyone's treating the market like a race. They're watching today's price, not the long-term value. Buffett has another famous line: price is what you pay, value is what you get. You can pay a high price for something worthless, or pay a low price for something incredibly valuable, and the market right now, as Buffett describes it, operates as a voting machine in the short term, driven by emotions, news, fear, greed. But in the long term, the market is a weighing machine. It measures what something is actually worth. What happened recently is that the market entered a phase where panic dominated everything. But if we think rationally, we'll find that Bitcoin's fundamentals haven't changed. In fact, they may be stronger than ever. The problem isn't Bitcoin itself. The problem is something much bigger: liquidity. Here's what happened. The US government experienced the longest government shutdown in its history. This shutdown forced them to stop spending, and when government spending stops, an account called the Treasury General Account at the Federal Reserve starts to swell. And as it swells, it drains liquidity from the market. The money that was circulating in the economy got pulled out and locked in government coffers. At the same time, the Federal Reserve was operating under a policy called quantitative tightening, meaning they're reducing the money they pump into the financial system. So you have two forces simultaneously sucking liquidity out of the market, and this affects all assets: Bitcoin, stocks, real estate, anything that's bought and sold. When liquidity dries up, everything suffers. Now let's talk about what nobody's paying attention to. What made this crash take such a strange shape? What happened starting October 10th was something extremely unusual, and the market could feel that something wasn't normal. This wasn't just people selling. Something broke. Bitcoin's movement wasn't just fear. Something big experienced forced liquidation. The liquidity in the market disappeared suddenly, not gradually, not one by one. Suddenly, all markets were affected. There was nowhere to park cash. Even money market funds ran out of places to store excess cash. Interest rates on overnight lending between banks started climbing week after week. According to Bloomberg's analysis, market makers reduced risk exposure dramatically. Traders pulled leverage. The entire market started coming apart at the seams. And when this happens, Bitcoin is always the first to get hit because it's a high-risk asset that moves fast. Before we go deeper into the technical analysis, if you're finding this breakdown valuable and want daily insights on crypto and financial markets, hit that subscribe button right now. We're building a community of informed investors who understand what's really moving markets. Your support helps us continue this level of research. Now, let's examine what the data is really telling us. So here's the critical question. Is this the end of Bitcoin? Absolutely not. What happened is simply a reaction to a temporary liquidity shortage, not because people lost confidence in Bitcoin. Bitcoin's fundamentals remain strong. In fact, many investors see this as the best buying opportunity if you're a long-term investor. But the key is understanding that markets aren't always rational in the moment, but eventually they return to measuring true value, and that's Buffett's advice we need to hear. If you're a short-term trader, you need to watch liquidity, leverage, and daily indicators closely. But if you're long-term, you need to look at the big picture. Is Bitcoin still playing its role? Is demand increasing? Are institutions investing more heavily? If the answers are yes, then this drop isn't a catastrophe, it's just a correction. What happened on platforms like Binance is a perfect example. The CEO stated plainly that the automatic deleveraging system malfunctioned severely, and people's positions were liquidated at illogical prices. Shortly after, we saw Three Arrows Capital, which was operating a market-neutral fund, meaning they supposedly don't profit or lose from market movements. They lost $93 million and shut down. Why? Because they fell into the same ADL trap. And since then, the pattern became clear. Every single morning at 9:30 a.m. New York time, the moment US markets open, someone sells Bitcoin. Same method, same timing, same quantity. This isn't a normal individual. This isn't retail panic. This is clearly a forced seller, like a fund closing positions or a market maker. Liquidating. They're not selling because they want to sell, they're selling because they must sell. And when we look at technical indicators, we find that the MACD reached the lowest reading in Bitcoin's entire history, lower than COVID, lower than the FTX collapse. Yet the price is only down 33%. This is impossible in a healthy market. The RSI hit 21, a number that only occurs during true capitulation. But strangely, we're not seeing obvious capitulation. This isn't fear-driven selling, this is forced pressure. All of this means what happened on October 10th was a real break in market structure resulting from liquidity shortage and forced liquidation, not a change in Bitcoin's fundamentals. Now let's look at the bigger picture. Has Bitcoin itself changed? On the contrary, the fundamentals have strengthened. First, institutional adoption is higher than ever. In January, Bitcoin ETFs began trading, creating a permanent channel for institutional money into Bitcoin. We're talking about slow money like pensions, insurance companies, and sovereign wealth funds. This isn't money that trades daily, this is money that holds for years. According to SEC filings, BlackRock's Bitcoin ETF now holds over $5 billion in assets, making it one of the most successful ETF launches in financial history. This isn't speculative capital, this is institutional capital with decade-long time horizons. Second, banks like JPMorgan started accepting Bitcoin as collateral for loans, and this means it's become an official asset within the financial system. Even the FHFA, the agency that oversees Fannie Mae and Freddie Mac, announced that mortgage insurance companies can count Bitcoin in borrowers' financial strength. Bitcoin, which used to be seen as something incomprehensible, is now being counted in credit assessments. Beyond that, major companies like Fidelity, Citi, US Bank, and Standard Chartered now offer official, regulated Bitcoin custody services. The Bitcoin being stored with them isn't being sold or traded. It's locked in cold storage and disappears from the market for long periods. Let's also look at mining. The hash rate reached an all-time high, and this proves the network is stronger and more secure than ever. This tells you miners are confident in Bitcoin and are investing hundreds of millions, and short-term price volatility doesn't concern them at all. There's also sovereign adoption happening. The United States holds over 200,000 Bitcoin in reserves, and states are studying holding it, and other countries are considering moving in the same direction. It's still early for this phase, but the direction is clear and explicit. So when you add all of this up, institutions buying, banks adopting, markets accepting it as collateral, institutional custody, mining increasing, governments examining it, and you find the price down 35%, there's a huge gap between reality and sentiment, between price and value. What's happening now is a massive opportunity, not a crisis. The market is currently acting emotionally, not measuring true weight. The weighing phase hasn't actually begun yet, and people like me who see the long term consider this a buying opportunity. But the most important message I'll tell you at the end is, don't confuse a broken market structure with a broken asset. Don't confuse forced sellers under pressure with fundamental deterioration. As Warren Buffett always tells you, when fundamentals are strengthening and prices falling, that's a good opportunity disguised as a crisis. And that's exactly Bitcoin's situation right now. More important than all of this is keeping your strategy aligned with your goal and time frame, not with the scary headlines. The question isn't whether Bitcoin crashed. The question is whether you understand the difference between temporary liquidity crises and fundamental value destruction. Looking ahead, I see three possible scenarios. Scenario 1, 40% probability. The forced liquidation completes within 2 weeks, liquidity returns to the system, and we see a sharp recovery back above 100,000. Scenario 2, 35% probability. We consolidate between 80 and 90,000. For 1 to 2 months, building a base before the next leg up. Scenario 3, 25% probability. Further selling pressure pushes us down to 75,000, creating an even better accumulation opportunity before the eventual reversal. Each scenario has different implications for your strategy, but all three scenarios assume the fundamental thesis remains intact. The last time we saw a drawdown of this magnitude was March 2020 during the COVID crash. Bitcoin dropped 63% in that event, but within 18 months it rallied over 1,000% to reach its previous all-time high. Or look at the FTX collapse in November 2022. Bitcoin fell 42%. Everyone declared crypto dead. Yet 12 months later, Bitcoin had doubled and ETFs were approved. History doesn't repeat, but it often rhymes. The pattern is clear. Temporary liquidity crises create the best buying opportunities for those who understand the difference between price and value, between market structure breaks and fundamental deterioration. So here's my question for you, and I really want your perspective in the comments, based on everything we've analyzed, the forced liquidation evidence, the strengthening fundamentals, the institutional adoption data, the technical indicators. Do you see this as a buying opportunity, or are you waiting for further confirmation? What's your strategy in this environment? Let me know below, and let's have a real discussion about navigating these markets. I'll see you in the next video.